Dividend investing is getting increasingly popular amongst investors these days, predominantly because it's a great strategy to generate reliable income. And for those looking to wind back the number of hours they're working or wanting to retire completely, dividend income plays a crucial role. But the unfortunate reality is that a lot of investors get it wrong, and what they end up with is a portfolio they don't understand, with irregular income, and in some cases, they can actually destroy the capital they worked so hard for in the first place. So, in this video, I want to talk you through simple steps you can follow to set up a reliable dividend portfolio. The first step, and actually the most critical one, is to figure out your strategy. Your strategy is important because there are effectively only two types of dividend stock you can choose from. And the simplest way to think about this is how much of this company's profit do I want to take as a dividend? The first type of dividend stock is often called a dividend aristocrat, high yielders, because they're often paying above 5%, sometimes as high as 10% dividend yield. Although, as a rule of thumb, the higher the yield, the more skeptical you should be. These are the type of companies that you read about in dividend newsletters. From a dividend perspective, these type of companies often tick all the boxes. They have a solid track record of payments, continuously growing, some as long as 50 years. They are typically well-established, mature businesses who are paying out the majority of their earnings as a dividend. So, what's the catch with these companies? On the surface, they sound like the perfect fit for an income portfolio. The catch with these businesses is that you are often exchanging capital gain for dividends. The easiest way for me to demonstrate this is with the Simply Wall Street stock screener. I'll put a link to this in the description and in the pinned comments, but you can find our screener by coming up here on the right hand side, and you can also find it in our mobile app. I'm going to make a quick screen just to illustrate this point. So for a dividend aristocrat, I literally just ask for everything. I'm being greedy here. I want 6 out of 6 on the Simply Wall Street snowflake. You can see that 6 out of 6 is actually pretty tough. It's pretty hard to match. Only 268 results worldwide. And if I filter that even more for the US market, there's only 46. In fact, in some countries, I think there's 0 matches. That's how strict it is to be a dividend aristocrat. But here's the catch. If I also want to say that the 3-year return of these stocks has matched the US market, which is 55% roughly, look what happens. All of those companies disappear, right? It's basically impossible to have both. This is a great example of the paradox of high-yield dividend investing. It's difficult, although not impossible, to have both a high-yield company and a company that keeps up with the market. Now, of course, here I'm being a little greedy. I'm asking for both high yield and capital gain. Whereas in reality, a much better framework for dividend investing is to think of the high yield as an exchange. I'm actually swapping the potential for capital gain with a guaranteed dividend payment. This is of course extremely attractive to someone building an income portfolio. As everyone knows, investing carries risk. Not only do companies fail to execute on their plans, but the market or industry may face headwinds that are completely out of their control. So I would say for this strategy, it's more realistic to simply aim for the companies to keep pace with inflation. For example, that could be 3% a year. If I go and update my screener filter to 3% a year, obviously not compounded, but let's just be simple here and say it's 9%, that does increase the number of results, but not by that much. By choosing this high yield strategy for your portfolio, my advice would be to acknowledge that you are deciding to take the guaranteed dividend payment in exchange for capital growth. And at a bare minimum, try to avoid companies that will erode value in exchange for your dividend payment. Let me quickly show you a real example of where this paradox is played out. I am going to show you Verizon, and I'm just going to go up the top here and search for the Verizon company report. Verizon. Here we go. So I'm in the company report now, and the first place I want to show you is the dividend section. You can navigate just by clicking here on dividends. In the dividend section, this company is a dividend aristocrat. There's no doubt about it. It's passing 6 out of 6 of our checks. It's got a really high yield, look at, these payments as something out of a playbook, constantly growing payments, increasing every year. But here's the paradox. If I go back up to the overview and I can go to this other section, which is shareholder returns. And if I open the shareholder returns, I can see that in the past 5 years, while the market is up 64%, the stock is down 30%. And even if I include dividend returns, it doesn't really help much. I'm still down 7%, even including the dividend payments in the past 5 years. A better example of an aristocrat would be a company like ENI. So ENI, if I search ENI in the top, first of all, unfortunately, guys, it's not an American company. We do have every stock in the world on here, but ENI is a great example. Now you'll see the dividend here, it's not quite meeting the Aristocrat 6 out of 6 criteria. In fact, that's because it's actually cut its payments here, but it's still got that really high dividend yield. The dividend is still affordable. You see 29% of earnings going to shareholders, 77% or almost 80% cash. So it is in that aristocrat or that aristocrat yield. But let's have a look at the same thing here. Let's go down and let's look at those shareholder returns. And this looks really different now to Verizon. First of all, this is the Italian market, so we can sort of ignore that one for now. But 5 years from the share price return point of view, ENI is up 92%. If I include dividend returns, it's up almost 170%. And so this is where you can see it is still possible to have both, but just very difficult to find. Let me show you how to screen for those high yielders. So I am back here in the Simply Wall Street Stock Screener. I'm going to show you for the high yielders 3 kind of inputs that I would recommend playing with as a starting point, and we're going to keep it really simple. The first I kind of gave you a little hint at earlier is simply the Snowflake dividend score. It is tempting for these companies, for these aristocrats or these high yielders to go straight for that 6 out of 6, but that is a really strict criteria, and I would actually soften it a little, probably go for a 5 out of 6. That is a huge difference. Did you see that? 6 out of 6, 268. 5 out of 6, more than 2,000. So that softening really opens up the market. For this video, I will use the US, but again, you can pick whichever market you're in. So now I've filtered it down, and in my market, for example, US, I'm now on 428. What are the other inputs I'd recommend using? I would say that you can look at the past 3-year return, right, to check if it's eroded value, but that's in the past. Right. So just be careful. I use that to illustrate the point, but you don't have to use that. But I think it can be a way of saying, well, I don't want companies that are eroding value. Maybe the company has already eroded so much value, it can't erode any more value. So I would say that one of these is probably a good option, though, because you just don't want to have a company that's eroding too much value. So you could say, well, I don't want it to have eroded more than 10% of the value in the last 10 years. And that's now the results haven't changed that much. We've gone from 400 to 200. It's not too bad. So that's the filter that I would say you can play with. If you want to soften that, you can just use the 1-year one because, who knows, that the company may have dropped in value. Now it's a good time to enter. But I think the important one to play with here is actually these metrics. So first of all, we've got dividend yield and forecast dividend yield. So I think you might want to say that the dividend yield, well, I am looking for something that is at minimum 5%. And the forecast one, by the way, is really powerful because that's what the analysts think it's going to be in the future. But for now, we'll just use a dividend yield. So if I add that into this screener, I can see that's actually cut down massively. Do you see that? We've gone from 200 now to 21. Big cut in the results. Like I said, this type of investing is not straightforward. There's no magical companies here. There's one other thing that I would recommend playing with in this screen, and that is the growth rate. So if I come to here, we can see dividend growth. This is really great because this is the rate of growth, annual growth of the dividends. And I think you really want that to be at least positive. You want some growth, right? I don't know why you want negative growth. So again, depends how greedy you're being, but I might say 2%. 13 results. So again, just remember the classic thing with screening is this is just a starting point. I will also put a link in the description and the comments to a pre-made screener that you can just go straight away and click on. But I do encourage you to explore in here in the screener and get a play for how these different inputs in your market, what's available. The second type of dividend company we'll be calling our dividend growers. And these companies don't look like the aristocrats we just showed earlier. This is because these type of companies are growing And when we say growing, we mean they're growing their earnings. Because they're growing their earnings, these companies often have a valuation that's quite a bit higher. And because they're growing their earnings, it makes sense for them to be reinvesting them. And that means they're going to pay out less of their earnings as a dividend. Typically, you see these companies paying anything between maybe 1.5 to a 3%, maybe 4% dividend yield. And the great thing is that with these companies, you can get both the dividend yield and the capital gain. They are often growing their dividends at a much faster rate than the Aristocrats are. And typically, though, you have to keep in mind that they won't always have decades of track record, and they may have even missed payments from time to time. Let me show you how to screen for growing dividend payers. So with the Snowflake, I'm going to ask for now 4 out of 6 on dividend. I'm not going all out because we know that's very hard to meet. So we're only doing 4 out of 6 on that Snowflake score, but we're looking for growing companies. So let's add that in. So I'm just going to make sure there's some growth in the past here, and there's some growth in the future. So it kind of looks like a bicycle seat. And that's going to give me now like a bit of a balance. It has to meet some of those dividend criteria, but it has to also be growing, and it has to have some growth in the past, which actually means that it's profitable. You can see that we've got just over 1,600 results now, but let's filter again just for this video for the US, but choose your own market. And we're down to 243 results. Let's add a few more criteria to finish off this screener. Now, I'm going to scroll down here to dividends. I went to metrics there. The first thing is the yield. We don't want crazy yields, but we want at least 2%. And let's say 2 to 5% could be a good range to start off with. And most importantly, these are growing dividend payers, so we want some growth. So let's say we want at least 4%. I'm going to drag that to 4% annual growth. And now you've got pretty nice. You've got 94 results to explore in the US. Now, of course, we can keep refining that. And remember, I will put a link to a pre-made screener with exactly this criteria in the description and in the comments. After you've narrowed down your screening criteria to a list of companies that you think are interesting, the next step is to do a quick check on the companies. And let me show you how Simply Wall Street can save you tons of time in doing that. So from here, I'm actually just going to click on, for example, the first one, which happens to be Home Depot, and we're just going to use this as an example. I'm now in the Simply Wall Street company report, and the easiest place to start for your quick check-in is our Snowflake over here. I can see from this that Home Depot is primarily a dividend payer. It actually scores really quite well on those dividend checks, but it doesn't look particularly undervalued. I'll show you that in a bit. There's some growth in there, right? They have some growth expectations, and they've performed okay in the past. To do this, you have to be somewhat profitable to get any checks on this section. And on the financial health, again, it looks like there's some red crosses, but it's not horrendous. And so that's all I need to take from the Snowflake. Think of it just as the characteristics of the company, and then we can dive in further. The place I would start is the dividend section. Surprise, surprise. In the dividend section, we've got basically all of the analysis behind these checks and a lot more detail. The place that I think is interesting is, of course, how the payments have been increasing year on year. So you can come to this chart and I can see these blue lines are the payments, but actually it's good to turn those off and even turn the yield off, because that goes up and down with the share price, and look at the annualized amount, because that is all of the payments throughout the years. Well, what does that look like year on year? And you can see here, this is still growing really, really nicely. The other bit that I think is meaningful is how much is the company paying out to shareholders? And you can see here for Home Depot in this example, it's pretty consistent. They're basically paying out just above 60% of the earnings and cash flow as a dividend. The next section that I would think is worth looking at is the valuation section. Why? Yeah, I know we're focused on dividends here, but you don't want to buy a company that is extremely overvalued. And so this gives you a really quick check-in. The first part here, and I have a dedicated video on this, is all about intrinsic value, or as we call it, the future cash flow value. And you can see here that actually the stock is a little bit overvalued, and this would be worth thinking about when we make our final decision. Finally, a section I think is also worth considering for a dividend company is the financial health of the company, the balance sheet. We can see here, like a company like Home Depot is actually passing sort of 4 out of 6 of our balance checks. And that's because this company, as an example, has a huge amount of debt. You can see that red line is the debt. And I can even switch on here cash. I can see that compared to the 53 billion in debt, they only have 1.6 in cash. Now, luckily the dividend is affordable, but this is a really quick way to check on the balance sheet of the company. And you can even look down here at how the balance sheet is laid out, right? How does the debt compare to everything else? There is a lot more in this report. There's way too much for this video, but it really covers absolutely every possible area from a fundamental perspective of a company. So I think this report saves you a lot of time when you're researching companies, and then it lets you move on to the next phase, which I will explain right now. The second part of your strategy is deciding on your time horizon and how much you plan to contribute. Think of this as your contribution plan. If you already have the funds ready to deploy into a dividend portfolio and you want to do that imminently, then you can actually skip this step. But a really quick way to explore this aspect of your strategy is to use our dividend calculator, which I'll link to in the description. Here, you can explore how different strategies will play out over 10 years or more. And remember, you can't easily have both high capital growth and yield. There's also an alternative to this, which is to create a dummy portfolio in Simply Wall Street containing the stocks you think could be a good fit for your portfolio. And Simply Wall Street will use that to forecast what your payments will look like in the future. To do this, I am going to go into the Portfolios tab up here and choose the portfolio that I'm analyzing. Here, I'm just going to use an example, which is a portfolio called Transactions. The place we're going to start is the Dividends tab, which is right here. And what we can first see is we are now forecasting the dividend payments out for the next 3 years because we actually have that data from analysts. So we have a pretty good idea of where the payments are going. You can also see here that we've broken down that forecast by the different groups. And as we know, the ones on those higher scores are very close. They're going to be very similar to those Aristocrats. The ones in orange are going to be closer to those growing dividend companies. Now you can use this to see, well, with my payments, how is it broken down by the different types of companies? And of course, I can click on them to look at the full report. We also have the estimated future payments, which is basically a dividend calendar. I can see here that these ones in teal are the declared payments. These have actually been formalized by the company, but we are estimating the payments out for many, many years. And you can actually see that in any given month, the exact amount and total that you're expected to be paid. And because we have that data from analysts, we can do this very accurately, unlike anyone else. And just quickly, let's look at updates. Because in updates, we also have updates on dividends. And this is where you'll see any news or announcements that the company has made about their dividends, whether they're announced, whether they've been increased or they're staying the same, you will find it here. The last and final step in our process is to make a decision to buy the dividend company or not. And the best way to do this is using narratives. This is because it's actually dangerous to buy a dividend stock purely for its payments whilst ignoring the valuation of the company and what the future holds. Let me quickly explain what a narrative is. A narrative is a story about the future of a company paired with a fair value. You might be asking, why are we talking about fair value when we're talking about dividend stocks? That's because even if you're going for the high yield strategy, then as we pointed out earlier, as a bare minimum, the fair value of the company should at least be higher than the current price, ideally with a margin of safety. And if you're buying a growing dividend stock, then it's ideally a lot higher. You can find narratives at the top of any company report you're on, or you can find them in your portfolio or your watch list. You can create a narrative yourself in just a few minutes. I'll link to a video explaining how to do it, or you can choose another one to follow. This might be from another investor in our community, or you can follow the analyst price target for the stock, or even the discounted cash flow value that we have on our company report. Whichever approach you decide, by choosing a narrative for each stock in your dividend portfolio, you'll be making disciplined, rational decisions, just as famous investors like Warren Buffett do. I call this the captain versus the pirate. A pirate is a bit of a gambler. They rely on their emotions to make decisions, and they don't really have a plan. A pirate can get lucky, but over the long run, those poor decisions will catch up with them. And every investor actually starts out as a pirate, but the goal is to become a captain. The captain has a plan. They make rational decisions. They stay calm in a storm. And when you use narratives and fair values to drive your decision making, you'll be making decisions like a captain. And in the long run, this will increase your portfolio's chance of success. Hopefully this video gives you a clear approach to building your dream dividend portfolio. Every tool that I've showcased here as part of this process is available right now, and I will link to each of them in the description. The best part is all of these are free with a Simply Wall Street account, and you don't even need a credit card. Finally, if you have any questions, please ask them in the comments and I promise to reply to each one.